On this, we're joined by Stephen Innes. He is Managing Director at SPI Asset Management. Good seeing you, Stephen. Sir, thank you for your time. So, it's said everywhere, every day, gold traditionally performs well in uncertain times, but we've seen the bullion falling more than 15%, really, since the Iran war began. Why is this a very different story, you think?
You know, gold's recent weakness has surprised many gold investors because it appears to violate what's the traditional safe haven playbook. This time, however, markets are playing it differently. In fact, they're actually trading it for liquidity as much as fear now. You know, one of the major downside catalysts was really one of the marginal central bank gold buyers turned marginal seller, and that's when the Central Bank of Turkey reportedly mobilized gold liquidity to help save some of the rising energy costs via swap. What that really did was remind investors that gold, not only a store of value, but hey, it's a great store of value to have in troubling times. So what we've really seen now here is sort of a domino effect that when oil prices rise, investors and gold traders think, well, who's the next domino to fall? In other words, who's the next central bank that may perhaps mobilize gold to hedge some of their oil imports? And that's a little bit of a problem that's working through the market right now. Besides that, what we've really witnessed is more of a transfer of how should I say, weak hands to strong hands again here. You know, the speculative community has been selling gold recently, but hey, underpinning this is still the central bank demand. So really, I think gold prices are probably seen pretty close to the bottom after this substantial correction. But the question is, what's going to drive them higher over the next little while? And I have a myriad of answers for that may best serve for a future dialogue.
We'll try to get you back at some point in time to talk about that in particular. But as we said earlier, central banks are now holding almost as much gold as they did during the Bretton Woods era. So do you think we're seeing a return to gold's historic role in the financial system?
I would say yes, but not in the way many people imagine. We're not returning to the gold standard, and gold is not about to replace fiat currencies. What we're really seeing is gold reclaiming its historic role as a strategic reserve asset. You know, for decades, reserve management was built around the assumption that US Treasuries were absolutely and ultimately risk-free. That's been challenged. The world's become more fragmented. Sanctions, geopolitical tensions, growing fiscal deficits, that's the big one. And the worst of all was the weaponization of financial systems have encouraged central banks to really think about reserve diversification. Gold offers that unique handle. It carries no counterparty risk. It doesn't politically align to anybody. And, you know, it makes sense. And I think that's why we're seeing central banks walk down that alley and really backing up the gold truck to the vault these days.
All right, we'll have to leave it there for now. Stephen Innes, great speaking with you. Thank you so much for your time, sir.